Hi friends, good morning. Welcome back to my YouTube channel. Today I'm going to talk about revenue and capital expenditure. First I'm going to talk about capital expenditure. What are the capital expenditure? What is the nature of capital expenditures? Why it is incurred by the entity and what is the accounting treatment? Let's discuss capital expenditure. What is the capital expenditure? Capital expenditures are those expenditure, the benefit by which company can enjoy over longer period of time is called capital expenditure. Example, machinery purchased. Machinery purchased of rupees 9 lakh. Machinery purchase of rupees 9 lakh. If machinery purchase different location than the factory premises, we need transportation cost, right? Transport. Transportation cost of rupees, say for example 50,000. 50,000. If the machinery we already bought to the factory premises, we need installation to function the machinery, right? So installation cost is required. Installation cost of rupees 50,000. Just imaginary example, okay? What is the total aggregate cost of machinery purchase now? 10 lakhs. What is the total cost? 10 lakhs. Okay, the total machinery purchase cost is how much? 10 lakhs. Because my machinery purchase cost is 9 lakh. To bring that machinery to my office, factory premises, the transportation cost incurred is 50,000 and installation cost is 50,000. Total aggregate cost of the machinery is 10 lakh rupees. What this is called, considering transport and installation cost is one of the accounting cost concept. What is that accounting concept? Cost concept. What is the cost concept is talking about? We need to consider all the relevant expenses that need to be recorded in the books of account, right? That is the cost concept. Now come back to the capital expenditure concept. Now, okay, this is called capital expenditures, and the total cash outlay for the capital expenditure is more. When I was talking about what is the nature of the capital expenditure, it is a non-recurring expenses. Why it is non-recurring expenses? Why can't it is a recurring expenses? If company purchases machinery in this year, it is not necessary to purchase in the following year or following months, and hence it is a non-recurring expenses, right? When it is occurred, why need company? Why capital expenditures are required by the entity? So, for example, machineries are required to produce a product. Without machinery, without land, without factory, a company cannot be produce a product, right? You may tell, sir, without a company, without machinery also will produce a product. Yes, of course, but to increase the earning capacity, machinery, land, and factories are required. For example, in this example, machineries. Say, for example, currently the company is producing 1 lakh units, 1 lakh units of the product. To increase the capacity of the machinery, that is the total cost is 10 lakhs. It's required an additional cost plus additional cost. Say for example 5 lakh. 5 lakh. Existing capacity is 1 lakh units can be produced by the machinery, but company want to expand, increase the machinery capacity to produce the more units. Say for let's say example 1 lakh, 1 lakh 50,000 units. 1 lakh 50,000 units. To increase the capacity of the existing machine, to have the 1,50,000 units of the product, an additional cost will increase 5 lakh. This 5 lakh is a form part of capital expenditure. Understand? To purchase of capital assets, fixed assets like machinery, land, building, whatever total expenditure incurred, those expenses are called capital expenditure. In addition to that, when the company is increase the earning capacity or existing capacity, the whatever expenses incurred are called capital expenditure. Again, for example, repair and maintenance. Repair and maintenance of cost 10,000. Is 10,000 is a part of capital expenditure? No, because it is not part of capital expenditure because it is not capital expenditure because it is a routine. The company is incurring this cost to make sure my machineries function as it is because my business operation will not disturb, right? Remember, repair and maintenance of a machinery is not part of capital expenditures, right? This is not part of capital expenditure. Now let's talk about accounting treatment. Capital expenditure cannot be write off or charged against to P&L account in the same accounting period, but rather it is recorded in the balance sheet as an asset. But the amount of capital expenditure divided into different parts and charged against to income in the P&L account, right? For example, my total cost of the machinery is 10 lakh and say the life of the machinery is equal to 10 years 10 years 10 lakhs divided by 10 years. My depreciation, therefore depreciation is equal to 1 lakh per year. My depreciation is 1 lakh per year. How we arrived? Life of the machinery is 10 years. My total cost of the machinery is 10 lakh. 10 lakh divided by 10 is equal to 1 lakh per year. This 1 lakh is equal to revenue expenditure. Why revenue expenditure? You may ask the questions. You already told machinery cost, part of the machinery cost, it is a capital expenditure. But again I am telling it, the depreciation, the amount of capital expenditure divided into different parts and charged to against to profit. That expenses is called revenue expenditures. Why? Sir, observe carefully. So for example, in the given example, my existing machinery can able to produce 1 lakh units of the product. To produce the 1 lakh units of the product, what are the expenses incurred? It can be salary, wages, gas, electricity, rent, etc. So all this form of part of total expenditure. But what is my cost of the machinery that is contributed to produce the 1 lakh units of the product? That is called a 10,000. That is called 1 lakh of the depreciation we are charging to profit. Is the revenue expenditure. Why we need to charge in the same accounting period? Because we need to collect the cost what we have incurred for the capital expenditure. Again, this is as per the matching concept, right? All the expenses what incurred in the same accounting period should be charged to what we have earned the revenue. Is it clear? Hope it is clear. So let's talk about revenue expenditures now. Revenue expenditures are very. Let's talk about revenue expenditures now. What are the revenue expenditures? Revenue expenditures are those expenditures the benefit by which company can enjoy the same accounting period are called revenue expenditure. For example, salaries. Example, salary wages, rent, gas, etc., etc. These all expenses are called revenue expenditures. What is the nature of revenue expenditures? These expenses are recurring in nature. Why recurring in nature? Every month I need to pay. Every month I need to pay salary to the employees. Every month I need to pay wages to the workers. Every month I need to pay rent to the factory, right? And hence these expenses are called recurring in nature. The cash outlay of the recurring expenses is a very minimal. It's not very minimal comparing to the capital expenditures, right? The accounting treatment of revenue expenditures is all the revenue expenditure should charge against to profit in the same accounting period. Why we need to charge? To establish the correct operating results in the accounting period, right? For example, salary account data to salary account data to cash account being salary paid when we are transferring to P&L, we need to transfer to P&L. What is the entry? P&L account data to salary account, right? First entry is salary account data to cash account, and then we need to transfer to P&L account. P&L debit, salary credit. Salary, and the salary will go, and cash and P&L will be there in the books of account. This is the accounting treatment. But again, why we need to charge all the revenue expenditure in the same accounting period? That is a very interesting. So as I told, it is a matching concept, right? Why matching concept is required? For example, as I mentioned with example, 1 lakh units of the product units produced by the company in a particular accounting period. Say for example, the selling price is 10 rupees. Now the total sales revenue is 10 lakhs. To earn the 10 lakhs revenue, what is my total expenses? Say my total expenses is 7 lakhs 50,000 is expenses. To earn the 10 lakhs revenue in the some particular accounting period, my total expenses incurred 7,50,000. This 7,50,000, this 10 lakh sales revenue should be recorded in the accounting same accounting period. Is called matching concept. So very important, very important. If you don't record any of the expenses in the books of account, if you don't charge any revenue expenditure against to revenue in the particular period, what is the impact? For example, it will going to impact capital, it will going to impact net profit, it will going to impact current liability. If it is a outstanding expenses, the current liability again pump part of working capital, then working capital will impact. Then working capital, if it is a working capital is impacting, then the current ratio will impact. That I will go and explain in the next class. Until see you, thank you very much for watching my video. Please do subscribe my channel. Thank you very much.